I want to bring in Doug Ramsey, who's joining us from the Leuthold Group. He's the CIO, Chief Investment Officer, to talk about what the firm is seeing right now. Doug, always good to have you here. Thanks for joining us again. Right now, what's most important to the U.S. stock story? I mean, is it just the fact that the Fed's got our back, or do you have to think about some of the complications where there is still some strength here in the U.S.?
I think the momentum of the economy is the biggest issue here, Oliver. I think it's a foregone conclusion. You're going to see a quarter point cut out of the Fed next week, but it's the momentum, and specifically in the manufacturing sector, that is troubling to us here. We just got some of the market PMI numbers out this morning, and they were weak. The number on the U.S. was right at 50.0, so it says growth is at a standstill in the manufacturing economy. And I know that the manufacturing economy is a much shrunken percentage of the total U.S. economy compared to previous business cycles, but it is still the tail that wags the dog.
Yeah.
And the bigger issue here is confidence. And if we continue to see this rollover in the manufacturing economy, it will eventually filter through to the broader economy as well. So I don't worry so much about what the Fed will or won't do next week. Trade policy is obviously big as well, in as much as it impacts confidence. So we're watching the factory numbers, industrial commodity prices very closely. I think that's the big issue, not so much what the Fed will do.
And to your point, Doug, the manufacturing figures really have been the clear weak spot, right? Even here in the U.S., they've started to roll over. If you look at the ISMs, I mean, everything kind of lines up. Then yesterday, we get the IMF saying we're going to downgrade the rest of the world, pretty much everyone but the U.S. Now, how does that sit in terms of where you see opportunity in stocks? I mean, do we have to go beyond just kind of the top level and think about which sectors are exposed to the weakness the most?
Well, it's interesting. What's showing up in our work right now puts us in sort of a barbell position where some of the defensive sectors like healthcare and staples in our rankings, and we do this on an industry basis, not a macro sector basis, but the staples are starting to move up to our attractive list. We've been heavy in technology for quite some time, and I'm not going to argue at all that the valuations are attractive. They're not. But I do think if this market and the economy were to power on for another 6 to 12 months, I do think those large cap growth stocks, and again, it would be a mix of the defensives and it'd be a mix of big tech as well. So a barbelled strategy. I do think they'll probably outperform those cyclicals, even though the relative valuations are less attractive on those sectors.
So to come back to the Fed then, because I feel like this still does, given that the relative valuation argument and the situation with technology right now, right? I mean, this earnings season, we're expected to see, according to Bloomberg, a contraction of tech earnings, anywhere between 8 and 10% from what I see. But that being said, it seems like the market, as long as Jay Powell doesn't have any surprises, then valuations aren't so much an issue. So does the return for a group like tech still kind of come back to the backdrop of what policy means for valuations?
Well, I think the big tech stocks, it's very different, obviously, than 20 years ago. There are some parallels in terms of the leadership. 2019 versus 1999, large cap growth, tech in particular, dominating. But the tech companies dominating today, I mean, the tech bulls will tell you this. I mean, they do have real sales bases. They're enormous companies. They're not just concepts, as many of the big ones, big in market cap anyway, not so much in sales, were 20 years ago. But I think, in this environment with very low rates, those stocks are perceived to have a very high duration of cash flows and stability of cash flow. So the lower rates makes those large cap growth franchises worth a lot more than a cyclical stock that's got this very volatile cash flow stream over time. So people talk about this great expansion in valuations since about the mid 1990s is when a lot of our stuff began to just break away from its historical norms. And I think that relates to interest rates, disinflation, and it's really resulted in a bifurcation of valuations where these large cap franchise growth stocks have gone to very, very high multiples, whereas groups like, industrial commodities, energy, materials, financials, they're still sort of tethered to these old valuation metrics. No one looks at price to book anymore. Even the most seasoned value investors have largely eschewed price to book, but price to book still seems to prescribe the boundaries for the financial sector and energy and some of the material stocks. So they still trade in these historical valuation ranges and have not benefited from this big drop in inflation and interest rates we've seen in the last 20, 25 years.
So, Doug, to your point about valuation, I know you guys look at a lot of different signals and things like, median valuation across the market. If I just look at the overall S&P, and this, or so far in the earnings quarter, we're getting about 2.8% growth. I think that's poised to change. At least the expectations are for it to change to the downside once some of the big cap names start rolling in. But still, an 80% beat rate. But yet, without a big push to guidance going forward, do you see this market as being able to withstand valuations on the S&P within sort of the mid-20 range? Because 23 was the high valuation we got in Jan 18 on a trailing basis, right? 23 times earnings, and it didn't last very long. Even with subsequent highs, we've had it with lower valuations. So what does it tell you about the market? Can we maintain froth above like a 20 times earnings?
I think it'll be very difficult with the slowing economy and relatively flat to down earnings. And you mentioned the valuations. The trailing PE on GAAP earnings today is 22.4. To put that in perspective, at the great market top of October 2007, we may have talked about this before, Oliver, but it was 18.4. We're 4 handles above where we were at an historic market peak. Despite the fact we're at higher margins, we're at a 9.9. The latest quarter, we were 9.9% net margin. So based on GAAP earnings, we are over 20 here today, 22.4. So I think that's very stretched. There is better news across the broad list of stocks, though. Over the course of the past few years, we've seen small cap stocks move from a significant premium the large caps to where they now trade at about a 15% PE discount against the large caps. So, small caps they've participated, but they're obviously not at new highs. Over the last 12 months, they're lagging by about 14, 15%. The good news is that's translated into lower relative multiples.
So now,
so I think the broad list of stocks is beginning to look more attractive compared to the big mega caps.
Interesting. So that's where I was going to go next, Doug, is everybody is kind of debating what the significance of this Russell underperformance is. From your research, what do you see from your perspective?
I think it's typical late cycle margin compression in the small caps. And we did a recent study. I really hadn't looked at things this way, but there's a figure called the GDP output gap. It's based on the actual level of unemployment compared to the government's estimate of sort of the natural full employment rate. So about a year ago at this time, it was second quarter of 2018, the actual rate of unemployment dipped below this full employment estimate. So in other words, we eliminated this negative GDP output gap that had existed for many years since the last financial crisis. What does that mean? We're at full employment, both in terms of labor markets and capital markets. Historically, that's been a negative for small cap margins and small cap stock performance, and it stands to reason that in a tight labor market, small companies have probably less flexibility to lure a new employee, whether it's wages. The benefits that a large multinational can offer, a small company just can't compete with that. So both from a fundamental and a performance perspective, this is the time of the cycle in which small caps tend to underperform. And of course they have, as I mentioned, by a lot in the last 12 months since that GDP output gap was erased. The question is how much is already in the price, because you've gone from a 40% PE premium on small caps, which was the all-time record by far 5.5 years ago, early 2014, to a 15% PE discount. So there's been a lot of revaluation that's gone on, not just in the last 12 months, but over the last 5+ years.
So then the implications for this, Doug, 'cause I think this is a really important point right now, because many will look at the Russell and they say, well, this is sort of reflecting, risk-taking behavior and the potential for an investor who wants to kind of extend on the risk spectrum. And well, by that logic, the S&Ps and the bigger caps may follow. But to your point, if it's more about this kind of margin compression and late cycle behavior that maybe is getting priced in, then maybe the gap between the two closes with the Russell actually, catching up if the situation improves. I mean, does the Russell provide any predictive power to what happens next for the big caps? I mean, are we going to start to hear about some of the larger companies also, talk margin? I know that, Goldman put out a big note we talked about coming into this earnings season about how this was going to be the theme, margin compression for big caps.
Yeah, I do think it predicts some margin compression to come for the big caps and probably weaker returns for the market. The issue is just the lead time. Small caps underperformed for a very lengthy period, 98, 99, before that had any ill consequence for the broader market. But I do look at this entire sequence here, dating back to January of 18, as an 18-month topping process. And again, we've drawn a lot of parallels to the late 1990s, but that was 23 months really from the internal, what we would describe as the internal peak of the market in April of 98 until the S&P 500 peaked in late March of 2000. So that was 23 months. We're 18 months into this thing. Again, the leadership has been nearly identical. Large cap and increasingly mega cap domination, growth over value, certainly domestic over international. All these themes are really repeating. I guess the big difference is the economy and earnings have been much weaker this time around than they were in 98 and 99. Although the large cap tech dominating are certainly real businesses, whereas some of them in the late 1990s were not.
Yeah. Doug, always a pleasure. Really good stuff. We got to run for now. I know there's always plenty to mine from your guys' research, but we'll continue the conversation. Good stuff. Doug Ramsey, Chief Investment Officer. Thank you.
Thanks.
At the Leuthold Group.